Property markets across Australia are entering a new phase of pressure. Interest rates remain elevated, and thousands of fixed-rate loans are about to reset. Here's what NSW Premier Chris Minns isn't highlighting. In 2026, approximately 62,000 fixed-rate mortgages across New South Wales will expire. Many of these loans were secured during 2020 and 2021 at rates below 2.5%. They are now rolling into variable rates between 6.4% and 6.9%. That shift represents a repayment shock of between $1,600 and $2,100 per month, up to $25,000 per year in additional mortgage costs. This isn't evenly distributed across Sydney. The pressure is concentrated in Western Sydney growth corridors. Let's break it down. Factor 1. The fixed-rate reset shock. During the pandemic, ultra-low rates triggered a borrowing surge. Households in suburbs like Blacktown, Liverpool, and Parramatta entered the market at peak affordability assumptions. At 2.2%, an $800,000 loan cost roughly $3,050 per month. At 6.7%, that same loan costs closer to $5,200 per month. That's a structural increase of nearly 70%. The economic mechanism is simple. When interest rates triple, disposable income collapses. Consumption slows. Savings evaporate. Mortgage stress rises rapidly. Current data suggests 28% of Western Sydney borrowers are already spending more than 35% of gross income on repayments. That exceeds traditional stress thresholds. Now compare this with Brisbane. Brisbane experienced strong growth during the same period, but median loan sizes are smaller. Median property prices remain lower than Sydney's $1.18 million. Debt-to-income exposure is less extreme. In other words, Sydney's reset risk is structurally higher. Factor 2. High debt meets elevated rates. The RBA cash rate sits at 4.35%. Variable mortgage rates between 6.4% and 6.9% reflect that tightening cycle. Australia already carries one of the highest household debt-to-income ratios globally. Sydney sits at the center of that exposure. When large mortgage balances collide with prolonged high rates, the result is fragility. In Blacktown, significant first homebuyer activity occurred during peak valuation years. Liverpool saw strong migration inflows and investor activity. Parramatta, positioned as a secondary CBD, attracted leveraged professional households. These are not cash-heavy prestige enclaves. They are debt-sensitive zones. If even 5% of the 62,000 loans entering reset fall into serious arrears, that equates to more than 3,000 distressed properties. At 10%, that becomes over 6,000. Distressed sales increase supply. Increased supply pressures comparable values. Falling values tighten refinancing options. That is how localized corrections begin. Factor 3. Policy constraints. NSW Premier Chris Minns has emphasized housing supply reform and planning efficiency. However, supply solutions operate on multi-year timelines. The fixed-rate cliff is immediate. Monetary policy remains under federal jurisdiction. With inflation still elevated, the Reserve Bank has limited flexibility. If rates remain near current levels through 2026, repayment pressure persists. Meanwhile, Brisbane and Perth continue to attract interstate migration. Lower median prices provide greater buffer capacity. That divergence matters. When one state faces concentrated repayment resets and another maintains affordability advantages, capital and confidence shift accordingly. Best-case scenario. Inflation declines faster than expected. The RBA cuts rates by 0.75% to 1%. Variable mortgage rates ease closer to 5.5%. Borrowers refinance into more manageable repayment structures. Defaults remain contained below 5% of expiring loans. Property prices in Western Sydney stabilize with minimal correction. Worst-case scenario. Inflation proves sticky. Rates remain elevated through late 2026. Unemployment rises modestly. 10% or more of resetting borrowers enter arrears. 6,000 plus properties move into forced sale conditions. Western Sydney pockets experience 10 to 15% price corrections. Negative equity expands among recent entrants. Most realistic scenario. A contained but uncomfortable stress cycle. Listings rise in Blacktown and Liverpool. Days on market extend in Parramatta. Price growth stalls or declines moderately, particularly in outer growth corridors. No national collapse, but a regional reset. Here's the structural warning. 62,000 loans resetting in a single year is not insignificant. Repayment increases of up to $2,100 per month are material. 28% of borrowers already exceed 35% income stress levels. Median NSW house prices remain at $1.18 million. Variable rates sit near 6.5%. When high leverage meets sustained high rates, risk concentrates quickly. This is not speculation. It is arithmetic. If rates remain elevated into 2026, Western Sydney becomes the front line of Australia's next mortgage stress cycle. Smith, Divi Tukstoshi Mortgages. Concentrated in one state, heavily weighted toward Western Sydney, resetting within a compressed 12-month window. That concentration is what matters, because mortgage stress is not just about the number of loans, it's about geographic clustering. When repayment pressure concentrates in suburbs like Blacktown, Liverpool, and Parramatta, the impact becomes local first. Listings begin rising in specific postcodes. Auction clearance rates weaken. Vendor discounting increases. That is how micro-corrections begin. Let's examine the supply-side response. When borrowers feel repayment shock, they typically move through 4 stages. Stage 1. Expense compression. Households cut discretionary spending. Retail spending falls. Local service economies slow. Stage 2. Liquidity drawdown. Savings buffers are used. Offset balances shrink. Redraw facilities are accessed. Stage 3. Refinancing attempts. Borrowers approach banks seeking term extensions, interest-only transitions, or rate negotiations. Stage 4. Forced decision. Sell voluntarily, or enter arrears. Data from previous tightening cycles shows that most borrowers attempt refinancing before default. However, refinancing depends on valuation. If property values stall or decline, loan-to-value ratios rise. That limits flexibility. Now compare with Perth. Perth's median house price remains materially below Sydney. Loan sizes are smaller. Deposit buffers are higher relative to valuation. That means repayment shock in Perth, while uncomfortable, carries less systemic weight. In Sydney, the base loan is larger. Therefore, the absolute dollar increase is larger. An extra $1,800 per month on a $600,000 loan is severe. On an $800,000 to $1 million loan, it becomes destabilizing. That difference is structural. Now consider unemployment risk. Western Sydney contains higher concentrations of construction, logistics, retail, and transport workers. These sectors are interest rate sensitive. If broader economic activity slows, employment softness compounds repayment stress. This is how feedback loops form. Higher rates reduce consumption. Reduced consumption pressures employment. Employment pressure increases arrears. Arrears increase distressed listings. Listings pressure prices. The mechanism is cyclical. Let's quantify possible impact. If 3,000 distressed properties hit the Western Sydney market over 12 months, that equates to roughly 250 additional distressed listings per month. If 6,000 hit, that doubles. In suburbs where monthly sales volumes may only range between 150 and 300 properties, that supply shift is material. Prices do not need national collapse to adjust. They only require marginal supply imbalance. Now compare with Brisbane again. Brisbane has experienced inward migration. Population growth offsets supply increases. Rental vacancy rates remain tighter. Sydney's growth corridors are larger and more leveraged. That leverage magnifies sensitivity. Another factor, investor positioning. Western Sydney saw strong investor participation between 2020 and 2022. Investors are more transaction-ready than owner-occupiers. They sell faster when yield compresses. With rental yields around 3% to 4% in many Sydney suburbs and mortgage costs above 6%, negative carry is common. If capital growth stalls, investors exit. That accelerates supply pressure. Contrast this with Adelaide. Adelaide's median prices remain lower. Investor entry points are smaller. Relative affordability reduces leverage shock. Sydney's high baseline amplifies stress. Now consider lending standards. A PRA imposed serviceability buffers of 3%. Borrowers were assessed at rates materially above their fixed rate. That provides some cushion. However, assessment buffers assume stable income and valuation. They do not account for simultaneous cost of living increases. Energy prices, insurance premiums, council rates, groceries. When multiple cost categories rise together, buffer erosion accelerates. This is why 28% of borrowers exceeding 35% income stress is significant. That threshold correlates strongly with rising arrears in historical cycles. Now, let's examine bank response. Major banks typically increase hardship support during reset waves. Temporary interest-only conversions. Short-term repayment pauses. Extended loan terms. These measures delay default. They do not eliminate principal exposure. If rates remain elevated into late 2026, temporary relief becomes insufficient. Now let's model a rolling correction. Scenario 1. Contained adjustment. Listings rise 8% to 12% in Western Sydney. Prices soften 5% to 7%. Refinancing activity increases. Arrears stabilize. Scenario 2. Accelerated stress. Listings rise 15% to 20%. Vendor discounting expands. Days on market extend beyond 45 to 60 days. Price declines reach 10% to 15% in outer corridors. Scenario 3. Confidence break. Investors exit. Migration slows. Credit growth contracts. Corrections deepen beyond 15%. At present, the data supports a contained stress scenario. However, risk concentration is elevated. Now consider political implications. NSW Premier Chris Minns has focused on planning reform, higher density targets, infrastructure acceleration, supply incentives. Those measures influence long-term equilibrium. They do not change immediate repayment arithmetic. Monetary policy remains controlled federally. The RBA prioritizes inflation containment. If inflation remains above target, rate cuts remain delayed. That timing mismatch matters. Supply reform takes years. Rate resets happen in months. This is the structural gap. Interstate capital flows reflect that gap. If Western Sydney weakens while Brisbane stabilizes, investment capital reallocates. Confidence follows relative stability. This is not a prediction of collapse. It is recognition of asymmetry. Sydney carries higher loan balances, higher median prices, higher absolute repayment shock. 62,000 loans resetting in one calendar year, up to $2,100 extra per month. 28% already above stress threshold. Median price $1.18 million. Variable rates near 6.5%. If even a small fraction transition from stress to arrears, localized corrections become visible quickly. The national narrative may remain stable, but regional volatility increases. That distinction is critical. Australia does not need a nationwide housing crash for pockets of Sydney to reset. Corrections begin locally, in leveraged corridors, under concentrated refinancing waves. Western Sydney fits that profile. This is not emotional. It is structural exposure analysis. If rates decline sooner, pressure eases. If rates plateau, stress persists. If rates rise again, risk accelerates. The arithmetic remains simple. Large debt balances, high interest rates, compressed buffers, 62,000 resets, concentrated in one state, within 1 year. That is not noise. That is measurable exposure. Subscribe so you don't miss the next video. Thanks for watching. See you in the next one.